Why does the CRA enforce 25% withholding on non-resident gross rent? If you're a non-resident earning rental income from property in Canada, you've likely been told about the 25% withholding tax on your rent. But why does the Canada Revenue Agency, CRA, take such a big cut up front, especially before you've even deducted expenses like mortgage payments or property taxes? It may feel unfair, but there's logic behind this system. The CRA uses withholding as a built-in safeguard to ensure non-residents pay their share of Canadian taxes. Here's what it means, how it works, and how you can reduce it legally. It's about enforcement, not punishment. The CRA doesn't have easy access to taxpayers who live abroad. If a non-resident earns income in Canada and then leaves the country, collecting unpaid taxes later becomes nearly impossible. To prevent that, the CRA created a withholding system. This ensures that taxes are collected at the source, meaning from the tenant or property manager before the money ever leaves Canada. That way, even if you never file a tax return, Canada already has a portion of your rental income. The 25% rate is a flat upfront tax. Under Part 3 of the Income Tax Act, non-residents must pay 25% of their gross rent. Gross rent means before expenses, no deductions allowed. The tenant or property manager withholds this amount and sends it to the CRA monthly. This 25% is not the final tax in most cases. It's simply a prepayment against what you actually owe. You can reduce it with Section 216. The CRA gives non-residents a way to pay less by filing under Section 216. If you file the NR6 form, your withholding can be reduced to 25% of your estimated net income instead of gross rent. Later, you'll file a Section 216 return to calculate the actual tax owed and claim a refund if you overpaid. This system rewards landlords who stay compliant. The more accurately you report, the less you'll lose to withholding. Who's responsible for withholding? The CRA holds tenants or Canadian property managers responsible for withholding and remitting taxes on your behalf. If they don't do it correctly, they, not you, can be held personally liable for any missing amounts, penalties, and interest. That's why working with a professional property manager familiar with non-resident tax rules is critical. What happens if you don't file? If you skip filing a Section 216 return, the CRA keeps the full 25% withheld as your final tax, even if your property made little or no profit. For example, if your annual rent is $36,000, the CRA gets $9,000. If your actual profit after expenses was only $6,000, you've effectively paid 150% of what you owed. The only way to recover the overpaid tax is by filing under Section 216. The takeaway: the 25% withholding isn't meant to punish, it's meant to protect Canada's tax system. The good news, by staying compliant, you can control how much you actually pay. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.